Okay, so pursuant to Section 84-1411 of the Nebraska statutes, notice of this meeting was given on Thursday, November 5th, 2020. Pursuant to that same section of the Nebraska statutes, the next regular meeting of the Board of Trustees will be held Thursday, January 7th, 2021, at 4 p.m. in the Board Conference Room, second floor of the Teacher Administrative Center, 3215 Cumming Street here in Omaha. The agenda will be kept current and available for public inspection in the retirement office at the Teacher Administrative Center during regular working hours. Pursuant to Section 84-1412 of the Nebraska statutes, the public is hereby informed that a current copy of the Nebraska Open Meetings Act is posted on the Board of Education meeting room on the north wall. Cecilia, would you call the roll?
Bourne.
Here.
Havlovic. Here. Hersenbach.
Here.
Johnson. Here. Logan. Placek.
Here.
Ray.
Here.
7 present.
Excellent, thank you. Moving into our agenda, we'll look at the regular meeting minutes for the meeting held on November 5th. Cecilia, I think there was an amendment to the minutes?
Yes, Mr. Chairman. So on page 3 of 9, the first paragraph was reworded to read as follows. It's very short. Mr. Ray noted that the OSERS investments are now totally under the control of the Nebraska Investment Council. Since the asset allocation for an investment pool is the main contributor to the rate of return, and since the NIC has complete control of the investments, he suggested that any bill that is introduced that impacts OSERS also include a provision that any change in unfunded liability that results from a change in the assumed rate of return be the responsibility of the state of Nebraska and not the district or the members of OSERS.
All right, thank you. Any other anomalies with the minutes that anyone else reviewed? Being none, take a motion to accept the minutes.
I move approval.
Second. We have a motion and a second. Any further discussion? Cecilia, would you call the roll on the minutes?
Johnson.
Aye.
Ray.
Aye.
Havlovic. Aye. Logan. Hersenbach.
Aye.
Placek. And Bourne.
Aye.
7 ayes.
All right, thank you. It's that time of year where we do the audit report. Syme Johnson is here. Darren Austin is partner with Syme Johnson is here to present. Welcome.
Thank you very much, Mr. Chairman and fellow board members. I want to thank you for the opportunity to continue to provide audit services to the retirement system. We greatly appreciate our relationship with you and look forward to continue to serve with you in the future. I want to thank Cecilia and her staff for all their work getting us ready for the audit, as well as the Omaha Public Schools accounting staff for getting all the information related to the financial statements together, as well as the members of the Nebraska Investment Council. They provided us all the information of the investments so we can conduct our audit procedures on those investments. But overall, the audit went very smoothly, and we will go through the results today. So my name is Darren Austin. I am the partner on the engagement. Sarah Greiger, the manager on the engagement. I was going to have her attend with me, and then something came up and she was unable to make it. But this is our 13th year doing the OSERS audit. So what we are going to go through today is your deliverables, and they are included in your bound reports. The bound item is the audit report, and then the loose item in there is the report to the Board of Trustees, which contains our required communication. So that is a summary of the audit results, as well as internal control related matters that we found in the audit. And we're going to go through those required communications with you today. And then we'll touch base on a few items within the audit report through some graphs and some of the information that's included in the required supplementary information, which is required by GASB Statement 67, accounting and financial reporting for pensions. So to go through the communications is our responsibility in accordance with our standards. So your audit is conducted in accordance with generally accepted auditing standards as well as government auditing standards, since you are a governmental pension plan. Management's responsible for the financial statements. Our responsibility is to express an opinion on those financial statements, and we plan and perform our audit to obtain reasonable assurance that the financial statements are free from material misstatement. As a result of our audit procedures, after the proposed adjustments that we do have a clean or an unmodified audit opinion. In our audit report, we do have an emphasis of matter paragraph to bring to the attention of the readers, and that is the valuation of the investments in the limited partnerships, because there is not a ready market for those investments. So there is approximately 22% of your net position is in investments in limited partnerships. These are valued at net asset value, and if a ready market did exist for them, the values could be different from what the current values are in the financial statements, and those differences could be material. Other matters to communicate, changes in, no new changes in accounting policies, no significant or unusual transactions, no alternative treatments discussed with management. There were no new accounting pronouncements this year applicable to the pension plan. Other areas we look at, so management's judgments and estimates. So we focus, obviously, the main asset of the plan is the fair value investments. So we spend a lot of our time focusing on that, as well as looking at the census information and things of that nature, more from a compliance aspect with the pension amounts. But we spend most of our time looking at the fair value of investments. And so we get the investment information from the Nebraska Investment Council, and then we conduct tests on those investments. So we do a lot of samples of the different types of investments, compare them to market prices, stated market prices as of the balance sheet date, and to make sure that the valuation is correct and accurate. For the limited partnerships, where there is not a ready market for those, we get recent statements from the fund managers and then look at any capital calls or any distributions that took place from that statement date, because it doesn't always coincide with your financial statement date. And then we also get the most recent audited financial statement of each of those partnership investments that we test, and we do some roll forward procedures with there to make sure that they are reasonable and consistent with the current statements or the most recent statements that we get from the fund managers. So based on the testing that we have performed after the adjustments proposed, the estimates were reasonable and consistent with prior years. As I said, we did have some audit adjustments. We had 4 entries this year, including 1 entry provided by management. Our adjusting entries, we had 1 entry related to the final investment activity received from the Nebraska Investment Council. That's usually an entry every year, just due to the timing of when that information comes in from the Nebraska Investment Council. And then we had 2 other audit entries to correct some misstatements in the financial statements as a result of things detected in our audit procedures. We did have 4 reclassifying entries that we made for financial statement presentation, and the audit entries are included in the report to the board as an exhibit. We had some reclassifying entries made just for financial statement presentation purposes, consistency between years. And then we had some past audit adjustments, or what we refer to as uncorrected misstatements. There's a schedule of those in the report to the board as well. This was primarily related to the testing of the limited partnership investments. We did have some variances within our testing, and then we take that and apply that variance to the total population. So we had an estimated misstatement of approximately $734,000, which we felt was collectively immaterial to the financial statements. That's less than 1% of the total investment balances in the financial statements. Some of that's just due to the nature of the tests that we are performing. Financial statement disclosures, we only really had 1 change or 1 new financial statement disclosure. Otherwise, if you would compare last year's to this year's, the disclosure is the same. Like I said, there were no new accounting pronouncements or anything that affected the financial statements, and that was related to some previous litigation that was outstanding. You had a settlement related to the Atlantic Global Yield Opportunity Fund, and so that disclosure is included in the financial statements. Next slide is other communications that we have. Management did not try to influence the audit process. Very cooperative throughout the process. We're open to our proposed adjustments, and those adjustments were recorded by management as well. Our quality review is also in there. I bring that up because our quality review is good every 3 years. It expires the end of this year. We're actually going through our external quality review this week and are hoping to have that new report issued by the end of the month. But we did have a pass rating on our last quality review. That's where another firm comes in and reviews our audit processes to make sure we're complying with our standards. Internal control related matters. So due to the misstatements, the adjustments that we had related to misstatements that were not detected and corrected by management's controls, we did include as a reportable matter in accordance with government auditing standards as a significant deficiency in internal control over financial reporting. That requires us to include the nature of the finding and what occurred, and then the corrective action plan by management is included. Now, this was not isolated to OSERS financial statements. You have the district's accounting and finance department prepares your financial statements. We had a similar finding in their report related to just accounting and financial reporting over the financial reporting over the district as well. And it's just related to the adjustments that we found that were not detected by management's controls. And then we had 2 control deficiencies. So these are less in magnitude. They're not reportable matters. They are only included in the report to the board. They're not included in the audit report. This was related to some internal reporting. One of the reports we had some inaccurate data in a report used for audit related to a participant balance, and another one was related to information provided to the actuary that affects the actuarial valuation. There was only one participant monthly balance that was in error, so overall it was immaterial to the financial statements, and that is why they're not included as findings. But for management's reference to make continued improvements in the controls over those processes. So now we'll move on to the financial statements, just some highlights of the financial information. You can see 10-year presentation of the net position of the plan. Your overall net position for the current year was $1,378,000,000. Compared to 10 years ago, you were at $1,033,000,000. So it's 33% growth over the 10-year period. Compounded annual growth rate of 3.25%. And the net position is assets less liabilities. It's primarily your investments. Your liabilities in the plan financial statements are pretty insignificant from that standpoint. Total pension liability and net pension liability. So these are not liabilities that are included in the financial statements, but this is essentially the total pension liability, pension obligations to the retirees. The district is required to recognize their proportionate share of the net pension liability, and then the state also picks up a portion of that as well because the state has the 2% contribution requirement. So by GASB standards, they're required to pick up a proportionate share of the liability from that standpoint. The district share was approximately 90% of the total liability, and the state's portion is the other 10%. But as you can see here, so the total pension liability is the total obligations. The net pension liability, which is what the district records, is the obligations less the assets is what your net pension liability is. And that amounted to, at 2020, amounted to $936,166 million. It was a $9 million decrease from the prior year of $945 million. You can see it's obviously been trending. It's been flat the last 3 years. We'll look at another slide that will emphasize that. You can see the increase in the total pension liability. The blue line jumped up from 16 to 17 as the biggest increase, and that is when the discount rate changed from 8% to 7.5%. That discount rate is expected to change again, and the goal of the Nebraska Investment Council is to reduce that discount rate down to 7 or even 6.5 over time. I think the goal was to reduce it at 7% when the next experience study is conducted. So that will affect the liability going forward. We'll look at that in another slide. Here is the funded ratio over the last 10 years. And so you can see from 2014 to 2017 that funded ratio was declining. The benefit obligations was exceeding the assets each year. And so the change, I should say, so that was declining down. 2017 is when the new law went into place, where it was either the district had to put in either 101% of employee contributions or the actuarially determined amount required to maintain solvency. That kicked in 2017. And so you can see that what they call the ARC is what we usually refer to it as, the actuarially required contribution. That leveled off, that drop, and it started to tick up a little bit this year. There was a dip from 18 to 19, and that was because of investment results in December 2018. If you remember back, the market took a very adverse turn in December of 18, so the timing of your valuation at 1/1/19 was probably about the worst time you could have had a valuation performed for that year. So that's why that did tick back down from 18 to 19. But the actuarially required contributions, or the additional contributions put into the plan beginning in 17, was $12.5 million, and then $18.9 million in 18, and then $21.3 million in each of the last 2 years. So essentially, it's leveled that off, and then I know the ARC is projected to grow or be a little bit bigger each year, and then hopefully with some better investment returns over the years, the intent is to have that trend up. Obviously, that's not going to get trend up all the way to 100% funded overnight. It's going to be a long-term process from that standpoint, but it's nice to see that trend is moving in the right direction. So as I talked about a little bit ago with the discount rate and the impact that has, one of the required disclosures is the sensitivity analysis and what the impact of a change in your discount rate would be. So your current discount rate is in the middle at 7.5%, and you can see if the discount rate goes up, it lowers the liability. If it goes down, it increases the liability. So as I said earlier, the plan is to lower that discount rate to a more reasonable, down to 7%, and maybe even eventually down to 6.5%. So you can see kind of where that impact would be if there was a 7% discount rate now. It would be about halfway in between the two. So it would exceed that unfunded portion because the liability would be growing. And then next slide here is just a breakdown of the contributions as I just discussed in the previous slide. Employee required contributions is in the blue, the member contributions. The OSERS, the district statutory required contributions of 101% of the employee contributions is in the brown, and then you will see the ARC, or the additional required contributions to maintain solvency, is in red over the last 4 years. And we started this slide when that ARC began from that standpoint. And then the green is the state contributions into the plan. But the actual required contribution for 2020 was, based on the 1/1/20 valuation, was $19,825,000, and the district funded $21,357,000 based on what they had budgeted for that. So they put the full amount that they had budgeted into the plan. That is my presentation. Any questions?
Roger?
Yes, I do have a couple of questions. You mentioned that the Investment Council is looking at possibly changing the assumed rate of return. In actual fact, that's not the Investment Council's job. Their job is to earn the money. Setting the discount rate is actually the job of this board as well as the INPRS board. Now, they're the ones that will have to make that decision on whether or not they'll change the assumed rate of return, but it's not the investment council.
True.
The investment council is not behaving in a fashion that will get the investments to earn what they need to earn. So we may need to change that discount rate, but that's not something that the state determines. That's something we determine. Second item, on page 12, that's one of the reasons I want to look at this. I mentioned that in my comments last month, and it's reflected in the change we put in the minutes, that the change in the discount rate by itself changes the. I'm looking at the presentation, page 12, and what you just did here. The discount rate changes the unfunded liability. If the discount rate is dropped because the investment council is not able to earn what they're supposed to earn, then that does increase the unfunded liability. And currently that's a responsibility of OPS in some fashion. That's the reason I think that any bill that's introduced to look at OSERS ought to have a provision that the changes in the discount rate, because we have no control over that investment whatsoever, changes in that discount rate should be the responsibility of the state of Nebraska because they're the ones in charge of the investments. Just a comment on the discount rate.
Other questions? All right.
All right, thank you.
Thank you, Darren. Okay. All right, so we'll move down to agenda item 4. Action
Thank you.
on- Yep.
Thanks.
Action on the Peets and Company engagement renewal. We've used Peets and Company since 2017. Their contract expires at the end of this year. Apparently, the history is the OSERS Board of Trustees hired a lobbyist brought on by LB 447 back in 2016. And again, OSERS has used Peets and Company since 2017, 4 years so far. They are asking for their contract expires at the end of this year. They're asking for a renewal for the calendar years 21, 22. Kind of some of the highlights there. The agreement can be canceled on 30-day notice by OSERS or 60-day notice by Peets. I think Cecilia provided you with information relative to the contract in the board package. So. With that, Roger.
I move the Board of Trustees authorize the Executive Director to execute a new renewal contract with Peets and Company for the calendar years 21, 22 at the rate of $40,000 per annum.
Okay, we have a motion to renew the contract. Is there a second?
I second that.
We have a motion and a second. Is there any discussion?
For a number of years, we didn't have our own lobbyist, and the reason was we were part of the school district team. We used their legal counsel, and we used their lobbying counsel as well. 4 years ago, the state separated us out, made us a separate entity completely. At that point, we have found our own independent legal counsel. You really can't have a body represented, one attorney representing two different bodies that have different interests and have different political needs. It's rather like having a divorce lawyer representing both spouses. One of the spouses is not going to have their interests served because whoever pays the bill is the one they have a loyalty to. That's the reason we changed our legal agreement. We also need, I think, to have our interests in the legislature looked after by our own independent lobbyist. I'll just stop there for the moment. If there's other questions, I could respond to those, but I think that's probably sufficient for the moment.
So what's the amount we pay Pete's? Say it again.
$40,000 per year.
$40,000 per year. So just as a point of discussion, I have a hard time seeing the value that we get out of Pete's, and so that's kind of what I've been weighing. And given our current financial position, it's tough for me to spend any extra dollars on things that I have a hard time seeing where we've gotten value from them. You know, as an example, if I look over the last year, and if I try to think about, has Pete's helped us make a better decision in any case? Has Pete's helped us in the lobbying effort? Has there been any benefit that I can point to? And I have a hard time pointing to any benefit from the spend. And so, you know, my position is I just have a hard time tying a good benefit to the spend.
One of the things lobbyists do is work behind the scenes. So you don't often see a great deal of impact from the lobbyist directly unless you're involved in the legislative process up to your armpits. We're not in that game because we're an elected board rather than people who are actually dealing with the legislature on a day-to-day basis. From what I've picked up from the people I've talked with in Lincoln, who are actually legislators, they do have a conversation with the lobbyists we hire about our interests. He does express our views, and he is able to impact decisions in a way that would help the plan. The lobbyist is not designed to keep, I'll put it differently, the lobbyist is designed to keep the laws from working against the members. And I think that's what we need to do is keep a protective shield between the legislature and the members through our actions in the lobby, in unicameral.
So I'm going to support this, and one thing I would say is if you look at the Exhibit A of the contract, it talks about how the lobbyists meet in person with the client board at the beginning of each legislative session and provide some analysis and make some recommendations. I don't know if we've had, since I'm new to the board, I don't know if we've had Pete's in before, but we certainly should do that in January. But it seems to me to be a very reasonable investment for the things that we are, have in consideration relative to the plan and the interaction with the state. Any other questions, comments, thoughts?
I was going to say that I would feel in support of this because especially if we've got LB 31 on the table, if we end up, dissolving and moving down to IMPERS, this would be wouldn't that be a benefit, or am I just misunderstanding that piece of it? So I feel like that would be something that would benefit members to still be in communication with someone who can help them out if we're going to go that route.
Mr. Chair. And just one other thing. Pete's and Company does come in January,
Okay.
and then they come again in June, generally, and give us a recap, or when the session is over. And there are a lot of behind-the-scenes work that he does do and communicates with myself, legal counsel, and the board chair, that the board isn't privy to, just trying to figure out strategy or if something's going on, unless it does elevate to the point that the board needs to be made aware of it. So.
All right. Any other questions, comments, thoughts?
I guess just a question around Pete's and the Better Together Coalition. I'm not sure previously if they've engaged in conversations with each other, but just making sure that all of the information that's flowing between Better Together and what's going on at the state legislature, that it all is fitting together, and that we're really able to use that to make wise decisions or consistent decisions as a board as well.
Agreed.
And they are. I know the Better Together Coalition government relations person does talk with Pete's and Company as well. So.
Other thoughts, comments, questions? All right. Seeing none, we have a motion and a second. Cecilia, call the roll, please.
Johnson? Aye. Havelbeck? Hirschenbach?
No.
Logan?
No.
Plasek?
Aye.
Ray?
Aye.
Bourne?
Aye.
5 ayes. 2 nays. Motion passes.
Okay. The motion's passed, and we'll have Cecilia go ahead and execute that contract. Let's see. Next item is the item number 5, the trustee election calendar. Cecilia, you want to kind of outline what the calendar is, and then we'll go from there.
Okay, to remind the senior board members and just to update the new board members, in 2016, LB 447 passed, which provided that annually the membership of OSERS would elect one seat to the Board of Trustees. And in 2021 will be the certificated seat number 1, which is currently held by Mr. Havlovic. Okay. It's a 4-year term. It's a 4-year term to begin July 1 of 2021. We passed election policies back in 2017, and I want to remind the board and the listening public that if we only have one nominee for the seat when the nominations open, which will be in February, then we will not hold an election. The one nominated person would be deemed elected and hold the seat for 4 years. Just another thought that came up was the law does say that the person sits in the seat until their replacement is found. So even if Mr. Havlovic did not nominate himself and no one else was nominated, he would still be there. So the calendar is before you, and the hope is to have the process begin in January, and by May we have election results, and by June it comes before the board to be certified. Any questions?
Any questions on the calendar or the process?
I just have one question. Will we be using the same election company to run the election that we've done in the past?
Yes. And again, depending on, last year's was about $9,000, and it should be in about the same ballpark. Because now that we've used them, we're not paying for duplicate, setups and things like that. It's just changed the names. It depends on the number of mailings. That's really the cost, the mailings. Yeah. We could with the actives and this group, but we had to do a mailing with the retirees.
Any other further questions or discussion on the calendar itself? All right, I'd look for a motion on the calendar.
Second.
All right, we have a motion and a second. Any further discussion? Cecilia, call the roll.
Placek?
Aye.
Ray? Herschenbach?
Aye.
Johnson?
Aye.
Logan? Havlovic? Bourne?
Aye.
7 ayes.
Okay, thank you. Okay, so item number 6, we're going to have a discussion on the disability retirement policy and procedures. We'll probably hold a vote over to approve that until January to give you an opportunity to kind of think about it and digest it a little bit. But Cecilia, would you kind of go through the proposed disability retirement policy?
Okay. In light of our recent disability claim, I took a deep dive into our disability policies and procedures and how they've been handled in the past. And working with our legal counsel, we came up with the policies and procedures that are in your packet. The intent is twofold. If someone is inquiring about a disability retirement, that they actually make an application and not just call the office and ask. We want them to think about it. Provide us with their first letter from a physician that they are, in fact, disabled according to our statute. A person would be given a packet, the application, our statutes on the back, and how to go through the process. Okay. Once the person submits the application along with the first doctor's letter, that will initiate the beginning of the process, because the law does state that your disability is effective the first of the month following your first doctor's notification, that the board receives that doctor's notification. Okay. And then they'll be responsible, they will be responsible for the first doctor. I want to start instituting where we have our own physician that we send our disability applicant to, and that our physician will also give them a review and make a determination. Yes. We don't have that many, but that they go to one of ours, and if ours says yay, then concurs, then it's approved by the board. If not, the person has to start again or get a third doctor. But after that, we only pay for one. We would only pay for one.
So, what if they don't use our doctor? I mean, by statute, they just need 2 doctors.
Correct. We could go back to that, just take off our doctor and go back to 2. The other plan, other school plan, does use a series of doctors that they say you go to one of ours. So,
So what if they don't? We have to pay the teeth, kind of?
If I could just interject, I served on the state board for 5 years, so I know a little bit about how that works. This mirrors the process the state retirement system uses. The individual submits their own doctor's note saying they're disabled. Then I think you need to have an independent person saying, okay, that's what your doctor says, what does our doctor say? If the individual does not have the examination from the second doctor, their application is not complete and does not go forward. So they either meet the no, we pay for the doctor. In the state system, is what this is proposing. The individual pays for their doctor's visit, and then for our opinion, we pay for the opinion. And that's the same as it is with the state. For the second opinion, yes.
And under the statute, the doctor must be approved by the board. So there is that requirement in the statute.
Okay, and I just want to give the board a little bit of background of what we have open and why I took the deep dive into this. So historically, what has happened is someone has just called the office and said, I want to apply for disability retirement. Okay. Well, we currently have 3, I'll say, files of individuals who all seemed in 2019 made a call to our office and made inquiry. Correspondence was sent out to them, and they gave us the name of their physicians, right? But none of them, their physicians, replied back, right? So there's this open file out there. Now, fortunately, all 3 individuals are term vested, and all 3 individuals are eligible for regular retirement in 2021. So I'm just going to let those close out, and they'll go into regular retirement in 2021. We do have 2 individuals who, again, initiated disability retirement. Letters went out to the doctors' names that they gave us. For each of these 2 individuals, only one doctor returned a letter saying, yes, they are disabled. One dates back to 2018, and the other one dates back to 2019. Now, under the law, if they come back in 2021, we have to go back and start their retirement effective a month after the first doctor letters came in. So for those two, I will work with legal counsel and want to send out a letter in January that says we have these open files. If they're not completed by like April 30, we will consider it closed and you will have to start again. Okay. Then we have 10 retirements, 10 that were deferred. So we did receive 2 doctor's notes. They are deferring their retirement until a later date, which means they are continuing to accrue service credit because they are delaying taking the retirement. This is permitted by law. And for these, no. They're long-term disability. So for these, I want to send out a letter that will say, you are currently on deferred disability, and here is your statutorily end date, because the statute does say you can defer the disability payment for a maximum of 35 years of credible service, and there will be one person that went out young enough that we will max it at 35 years, or you attaining age 65. Why I also want to put that in writing is what I want to mitigate is someone going past age 65 and not contacting us and thinking they are continuing to receive deferred credit. So those will go out in January as well. But I want to put some closure to these and try to tighten up the process.
I believe the policy will. I think the policy will help guide the claimant along the process, and I think that's part of the problem. There just seems to be a lack of process, lack of sense of what to do next and how to do it. And I think at least this would put that in place, and it would be very beneficial for the claimant.
And the two that are that have the one doctor, and we're still waiting on that second doctor, and it's been several years, those will go out certified. Yeah. So that's it. If again, please look it over again. Your question you asked Mr. Hersenbach, and if you have more, please contact me if you have questions, and we'll look at this again next month.
I do have a comment that I think needs to be addressed before we look at the process again next month, and that's on the disability request form that the member signs. I guess this is what the member gets. So here's what you have to do. It has the statute on the back and a bunch of things, requirements on the front. The final paragraph of that one, I understand my application for disability retirement and all supporting documentation will be incomplete, and no action will be taken by the Board of Trustees with respect to the determination of whether I'm disabled or not, if I have not provided all documentation. The part that I have trouble with is the very end of that. Well, that indicates that the individual is responsible for paying for 2 licensed physicians, and that was not the intent. The intent is they pay for the first one, and we pay for the second one. So that needs to be changed. Okay. And I think that language might be reworded on that paragraph to make it crisper, to make it more completely understandable. I think we've used a few too many parenthetical phrases, and I think it could be put into clear language that would make it easier for the member to understand.
All right, I will work on that.
You should have been an educator.
I can't hear what you're saying.
Not many at all. But again, we still need the guardrails because people will start it and not follow through. Yeah, it's not a big deal, but.
Any other questions? No? Okay, so Cecilia will work on those changes that Roger suggested. We'll review this again, and we'll look for an adoption in January. All right, thanks for the input. Moving on to agenda item number 7, Cecilia, the Executive Director's Report.
Okay. On November 16th, the Nebraska Public Employees Retirement Board met for its monthly meeting, and Kavanaugh McDonald gave its actuarial report. And I'm just want to give everybody that heads up. They are strongly encouraging a reduction to the discount rate. So we will probably hear this. We will hear the same thing with our valuation report next year. Orrin Hill is their internal general counsel, and he did report to the board that he and the director participated in LB 318 hearing, which was the hearing to review for those plans that are less than 80% funded. Speaking of LB 318, Dr. Logan participated, and what was that phrase you used? You were back before the principal? You were back before the principal, right? Also, Mr. Hill indicated that he has reviewed 2 versions of intended legislation regarding LB 31. We haven't seen anything yet. And I understand why they've looked at it first. What needs to be written to match what they already do, and so we're supposed to see it shortly. And he indicated that according what he foresaw was that the transition of management from OSERS to the Nebraska Public Employees Retirement System would be effective in 2023. So it's going to be a long process if it goes through. Let's see. OPS instituted a new benefit this year, and it's a short-term disability product. I am talking with Mr. Wakefield because I want to make sure there's no implication on this short-term disability and going out on a short-term disability that would any way affect or how it would affect their service credit with OSERS, okay? Because the statute says you can only receive the service credit for actual compensation for services rendered or the use of sick vacation. So Mr. Wakefield and I have had one conversation really quick. I will come back in January with just a better understanding of it. Mm-hmm. Right. Right. And like I said, I just want to make sure the impact of it, and that people understand when they go out, like this will or will not affect your credit service, and you need to understand that. And so when you do retire and you say, I have 20 years of service, and we say, no, you have 19.7. So, yeah. Well, right now with the CARES Act and people using their own sick, right.
If somebody went out short term, that's not going to accumulate.
Exactly. It won't. So, next is OSERS compliance audit. So we OSERS, I, have been asked, along with our board president and others, to participate with the school district in a meeting next week to consider a compliance audit of the OSERS plan. This came about with the LB 31, and the Nebraska Public Employees Retirement System is required by statute to have a compliance audit every 10 years. And it's basically a compliance audit of all the plans that they administer. So if this bill goes through, everyone would want a compliance audit done of OSERS before it transitions over. So what's a compliance audit? It basically goes through administrative policies and procedures and how things are done, and it looks for any administrative deficiencies that need to be addressed. So whether this LB 31 goes through or not, I really think it might be a good thing that we have one anyway. Now, it would be a plan expense. I don't know what that cost will be yet. I'll have more details after we have the meeting next week. And so what kind of things would they be looking for in plan administration? To make sure the plan is administered in accordance with federal and state law. Something I don't think we have to worry about, but like required minimum distributions. Are we making sure that our participants take them? Okay. We don't have to worry about it as much because our participants at age 65 are looking to retire. And if you do work past 70 and now 72, if you are working, you're not required to take the required minimum distribution from that employer. So, one thing I know that I'm proud of, that I know we do well, is for terminated members. We process them through quick enough that we have very few that move and disappear and we can't find them. So either they are term vested and they're leaving their money here for a reason, or they are non-term vested, non-vested, and we have rolled their money out. So, thus taking the liability off the books. Let's see. OSERS, okay, next two things. OSERS staff will be working remotely beginning Monday, December 14th, through Sunday, January 3rd. And that is actually all staff at OPS, but for winter break. So just letting everybody know, we will be working remotely. I have a schedule with the staff on one person per week just running in to get the mail, scan it, and leave. Staff has been informed and understands that working remotely means you are available during your normal work hours. Okay. And January board meeting will be the State Investment Officer and Aon Consulting Group. That's just a reminder. And yes, and Pete's and Company will be on the agenda. And then finally, just a reminder to our retired members, your January pension payment will not arrive until Monday, January 4th, because the 3rd is on a Sunday, and we can't pay you the business day beforehand because that's the 31st of December, and that's a tax liability. So your payments will be 1 day late than normal, than when you're expecting it. That ends the executive director's report. Any questions?
Any questions for Cecilia? All right, thank you. We'll move down to trustees' report. Are there any trustees that have any information for the good of the board?
I do have a couple of items. We mentioned in our discussions earlier with the auditor about the assumed rate of return. And just as kind of historical background, we have tried to match the assumed rate of return with what we think we can earn and try to be consistent with what the state plans do. In the past, we had our own investment mix, and we did not always follow lockstep. Now that the investments are all managed by the same group, I'm not sure there's going to be any leeway or any likelihood that we're going to be deviating from the state rate. There is one, however, one exception. Their fiscal year and our fiscal year are different. And when you start the assumed rate of return that starts at the fiscal year or the actuarial year, those rates may slightly be different also. We need to make sure that we have the school board on board if the rate of return is reduced, because that will increase their liability unless they put into the bill that's going in the hopper that the changes in the actuarial or assumed rate of return are the responsibility of the state. That's the reason I continue to recommend that be part of any bill that might be introduced next year, because we no longer have the authority to control investments. We no longer have the authority to control that rate of return, and that means that the rate of return can be managed by the state. And since they can manage since the state can manage the rate of return, that means I think they ought to be responsible for any changes in the unfunded liability that are brought about by that management. I guess that's all I had for this time.
You realize that will never happen, though, right?
I think it could. If you don't ask for it, it's not going to happen.
Yeah.
But if you do ask for it, I think if you make the case, because the state is responsibility for all the state retirement plans, and going forward, I think if this plan is part of the state plan, it ought to be part of the state responsibility. It should not continue to be a state OPS function, because they're all state retirement plans if this merger goes through.
Yeah, I don't think there's any possibility of that happening. But
I prefer not.
It's okay if we disagree. I just think
I prefer not to be defeatist, but we'll see.
All right.
Any other trustees have anything to discuss for the good of the board? Scott?
No.
Okay, excellent. All right. Let's see. Okay, so we've got a couple things that we need to discuss in closed session. Faith?
I move the Board of Trustees go into closed session for the protection of the public interest and for the prevention of needless injury to the reputation of individuals to discuss with legal counsel and Cecilia Carta litigation matters affecting the trust fund and personal financial matters regarding members of OSERS.
All right, we have a motion to go into closed session. Do we have a second? We have a motion and a second. Is there any discussion? Seeing none, Cecilia, call the roll. Yes.
Havlicek. Hersenbach.
Aye.
Johnson.
Aye.
Logan. Placek. Ray.
Aye.
7 ayes.
Okay, we are in closed session.
Okay.
All right, so our
Okay.
closed session business is concluded. Cecilia, would you call the roll?
Hold on, 506. Okay. Bourne.
Here.
Havlicek. Hersenbach.
Here.
Johnson.
Here.
Logan. Placek.
Here.
Ray.
Here.
7 present.
The members are present. We look for a motion on the payroll, retirements, deaths, and refunds document.
I move the Board of Trustees ratify December pension payments in the amount of $11,179,957.05 to 5,098 payees. Approve December staff payroll in the amount of $31,836.55. Approve 5 new retirements effective December 1st, 2020. First pension check paid January 4th, 2021. Ratify the termination of 19 retirements due to the death of the retiree and the continuation of 4 joint and survivor annuities to the beneficiary. Approve the November refunds of $932,723.76 to 41 former employees and members of OSERS. And approve the payment of October accounts payable in the amount of $28,735.
All right, we have a motion. I look for a second. We have a motion and a second. Any discussion on the document? Cecilia, call the roll, please.
Ray,
Aye.
Havlicek, Placic, Hersenbach,
Aye.
Logan, Johnson,
Aye.
Bourne.
Aye.
7 ayes.
All right, 7 ayes, it is approved. Moving down to agenda item 11, is there any new business? Seeing none, we'll adjourn at 5:09. Thank you.
Okay, we're adjourned.